live stream. Hopefully this works. And I can see that I get volume. It says it's scheduled. Do I got volume? Test 1, 2, 3. This works. Seems like I got volume, okay. Share the link real quick. This will be a recap of the Before the Bell episode 2 for QQQ. This is officially episode 2, QQQ after the bell, and the entire purpose of this is just quickly speed run through the report that was created last night for preparing Tuesday, March 24th, 2026's trading day. I'll show you how I had drawn Monday's range and how Monday's range was setting up for the preparation of today, and how the scenarios, they're not perfect. They definitely don't represent every possibility, because you couldn't capture every possible scenario in just bear bull consolidation. It's not that simple. The reality is a mix of bear below yesterday's low, breaking back above yesterday's low, but oscillating, never really fully committing to either side. So whole point of the Before the Bell is to provide that the range from yesterday is going to map out today's price action, and based on that, here are the levels. So Monday was essentially the bull scenario that was outlined, opened 592, cleared Friday's highs, pushed to a session high of 595 and 8 cents. From there, sellers reasserted control. By the close, we had declined. We were at the highs on Monday up 2.2, maybe 2.3%. We retraced a little under 1% of that range. So most of the range that made the market green from Friday's close to Monday's open, I should say from Friday's close to Monday's close, actually, most of that range had occurred overnight, as was shown in that prior live stream. Intraday range still was 1.53%. If you take the measuring the high to the low of the intraday range, that would show us $9.10. That amount of range, you're not always going to have intraday 1.5%. Some days you get just 0.5%, where it's very low volume because it's the winter months or it's the summer months. Seasonality effects are there. People are on vacation, whatever. It's something that occurs. The amount of volume and range is affected by seasonality, and that's been talked about plenty in this channel. Check out the full seasonality report on the Substack at Beta Heuristics, still Beta Heuristics here. And the amount of range is always going to be determined by when are we trading. Spring months, we're going to be experiencing more volatility according to the seasonality analysis. It's just baked in across all 4 of the major U.S. stock market indice ETFs or index ETFs. So whole point of trying to communicate what the range is from Monday, it provides context for what Tuesday can be and possibly what the rest of the week has in store. So writing this report, preparing for Tuesday, was that Tuesday opens with a more nuanced picture. The bulls proved they could push higher. The bears proved they could fade the move. That's the main point that I want to get across, that is not communicated in the simple QQQ Before the Bell episode 1, episode 2. The scenarios do not sufficiently detail that the bull scenario is time specific. The buyers must be maintaining higher low structure to keep higher highs being tested, maintained, holding higher low structure, consolidating, breaking higher for that uptrend to maintain. Halfway through the day on Monday, we failed to hold that and we sold back down, giving back a large chunk of the range. And that risk, that possible scenario isn't communicated in the QQQ before the bell, I'm thinking of different ways to adjust the report. You let me know in the comment section down below how you think I could adjust the report to make it more user-friendly, more first-time trader, first-time reader friendly, provided the intraday, Monday intraday range will show that on here as well on the Thinkorswim platform, but basically just drawing the Fibonacci from the high to the low a day, the resistance levels from key levels, resistance obviously where sellers are likely to show up, and they are predominantly the range of Monday as well as the Fibonacci extensions based on Monday's range. The prior intraday range, Monday's range, setting up how Tuesday's range, what upside extensions will occur for the resistance as well as the support. Try to communicate the pivot point of 591.60 on the NASDAQ, derived from Monday's post-session Fibonacci drawing. Those 61.8% retracement of Monday's full range projected forward into Tuesday. Above it, bulls reclaim the upper half of Monday's structure. Below it, bears maintain control of the lower half. This is today's single most important decision line. There's specific price levels that will be respected algorithmically based on the prior range, the retracements of that prior range specifically. Technical snapshot. The Monday session recap was just that. Going into Tuesday, acknowledge that Monday had a volatile two-phase session. Initially, gap up, continuation by the bulls. Second half of the day, that's faded to the downside. And the report just goes into a little depth with that. The daily year-to-date structure, we closed Monday down 5.1% here. Year-to-date down 5.1% on the QQQ. As of today, the NASDAQ Tuesday, March 24th, closed down 5.8% year-to-date. I'll have another QQQ before the bell report prepared and break down the different scenarios, but this was the report from Tuesday preparing. This is from early morning Tuesday. I'm very much sleep deprived, so my apologies. Today's summary above, 591.60. That's a bull reclaim. Targets 595, 598, 600. Below 588 area, you would see bearish continuation more likely, and the targets would then be 585, 97, 582, 580. And between both of these levels is the consolidation scenario. Pretty straightforward, I believe. So when we look here at the Thinkorswim platform of the NASDAQ, so this right here is the 24th. We opened here below the, we opened actually at this price point. This is, you can call this the US market open, USMO, and we'll make it light blue so it kind of stands out. So that's our market opening price. You're opening below the low of Monday. You're trying to test it. You're failing. Immediately, you get the rejection lower. Immediately rejecting lower, consolidating, breaking higher, consolidating higher lows below yesterday's low of day, which if you have a very narrow mindset, you think because you're below yesterday's lows, you have to have a bearish bias. If you're trying to be in short positions as the market is pushing higher, you're losing money. You have to be a trader with a dynamic mindset. Understand that being below yesterday's low can be bearish in certain contexts. It's based on the structure of the price action, the sentiment of the structure. The structure here is consolidating for 5-minute candlesticks from basically 10 o'clock all the way up to 11 o'clock, and then you're starting to move higher. The movement higher today on Tuesday was a failure to reclaim 588. 588 again. Go down to the summary. 588 is that key area that was communicated in the summary of the report, that below it is bearish continuation. So it's not opening beneath it, you're immediately bearish, but you have a bias of bearish lean. Be cognizant of that, patient for the ideal setup. If there's going to be a sell move, before the market moves lower, it will try to move higher because the sellers want to sell high, the buyers want to buy low. So the way that the trade had occurred today was really waiting for hourly time changes, approaching hourly time changes. And I would say the second half of the day, with a day job, I don't trade any of this. So the only time I was even looking at the market was back here around 3 o'clock. I came to the market and I could recognize that I think I was looking at the 3-minute more so. Trying to remember now. Oh, I think I used this level here. I was trying to understand that, the lower high here versus the high of day compared to Monday's range, lower high versus Monday's high of day. So you still have this gap, which we could actually show from the close here to that open. You've just filled that gap. I think that's actually a more valuable, the context of the Fibonacci retracement, how the Fibonacci retracement is drawn. When you take that of the gap, you can just see that you're opening just below 50% of the gap. You fill the gap to the downside before bouncing, and you filled the gap that was formed over the weekend, and you leave gaps overnight unfilled as well. So fill one gap, leave one gap unfilled. Interesting how the market has moved. I only traded the 3 o'clock retracement lower and was trading I believe I was in the 585 puts. So here is 585 as a price. Right here, when I'm looking at puts and I'm buying puts in this area, the 585 strike is beneath the underlying price of QQQ. So the puts are at a massive discount because they have, depending on the expiration, if the expiration is a 0 DTE, they have 0 extrinsic value. They have only the amount of time until expiration, which at this point in time to the close is basically 20 minutes. That is an extremely small amount of extrinsic value. It has no intrinsic value because intrinsic value, how in the money is the contract. When the strike price of the put is beneath the underlying's price, it's out of the money. The out of the money contract with 20 minutes to go has no true value. The only value it gains is on the decline here of, at the lows, it's $2.83. I'm not gonna pretend that I was in that full move. I'm purchasing contracts at $35 a contract and selling them at 60, 85, 100. I'm scaling them out because I have a target of 145, but there's no guarantee that my targets are achieved given the volatility in the markets. So it's a small trade compared to total portfolio values. I understand risk management, having stop loss placements, so the full risk amount was not the full contract amount, but where the stop loss was placed. And if you're interested in that kind of trade breakdown of the specific trade for, it was the 0 DTE, the QQQ, P585 puts that moved from the 25-35 area up to a high of around 150, 160 into the close. Yeah, here's the contract. So the QQQ, this is March 24th, 2026. This is the 585s. And I was just simply taking, let me get rid of that. So this is not the full range, because this is me taking an unnecessary detour from the QQQ after the bell recap of the before the bell episode 2. The more I talk about this, the more I understand it, and the better I can trade on it, invest on this knowledge. So at this point in the trading day, let's use this box. Around here, the amount of extrinsic value and intrinsic value is extremely different than later on in the day. You're comparing at the start of the day when there's hours until expiration to now later in the day, there's only minutes, less than half an hour until the close. So what I was taught by a legacy day trader, shout out Mac would explain to me using the most recent high to low or low to high, depending on how the structure is created. It's always drawn left to right. You draw the Fibonacci from left to right. And when you draw it, I take the Fibonacci retracement tool. I don't always take the wick of the high. Sometimes I'll just focus on the close of that candle's high, closing into that high, down to the low, and I'm targeting that 50%. That 50%, $144, $145 a contract after entering 35 a contract, making the move higher. The pullback here nearly stopping me out before then the continuation to fill on the last orders. So always good to let a runner continue in case there is that expansion after the close or just into the close, but understanding that that is my target. And 145, 144 was my, if I were to sit in the trade fully, I need to have a profit target. I need to have if-then statements. If the trade is holding higher low structure and my stop loss isn't targeted or stopped out, my stop loss isn't filled, then I need to have an exit. Most traders that are experiencing a green trade to a red trade are fumbling along the execution of realizing the gains. When you cover, at what price you cover can be difficult for retail traders. Letting the chart tell you. I did not choose 145 because it's $100 more than my entry price. That was not the justification. It wasn't because it was a trade of over 100%. It was simply the retracement of 50% of the most recent high to the most recent low. That 50%, if we couldn't clear this golden zone, I would have been stopping out here. The only reason this trade worked is because I held the stop losses when we broke upside, moving stop losses from being in the $15 a stop loss, moving it to my entry price. We have the wicking, we move higher, we wick down, we keep moving higher, just covering partials, moving stop losses, ensuring that gains are realized. That's the entire objective when I have the time to trade, which is once in a blue moon, I guess. I have a full-time job, so from 9 a.m. till 2 or 3 p.m. most days, I can't trade. I can trade power hour some trading days, but you don't always get range. You don't get a setup where it is a high probability setup. Some people wouldn't acknowledge that this is a high probability short into the close. They're just not understanding the price action interpretation. Go to a 10-minute chart and try and show you more of the bigger picture. Because again, understanding the previous day's range, understanding that you're still holding lower highs relative to yesterday's highs, lower highs lead to lower lows. And again, I can just keep giving, I'll give the alpha away for free. The US market open, just plotting that price point is insanely useful, because if you understand that the best place to be long the market is when you're below the open of the day, because then you have a whipsaw. You can think of prices whipsawing, you can think of it as a rubber band, liquidity being stretched and then snapping. And if you consider the US market open as this inflection point where liquidity is oscillating above and below until it makes a decision, and often that decision is made overnight. So very quickly, I'm just going to change this equities to show the overnight, so you can see that the decision of what direction is being taken so far in the pre-market is pushing higher. You oscillated that US market open, and then in the after hours now you've rocketed higher. You're trying to hold back within Monday's intraday range, holding above. If the market on Wednesday can open above the highs of intraday, Tuesday intraday range, that may help the buyers in the short term, because we have to consider that the higher time frames, there could be exhaustion from the sellers, and we start to try and see buyers step in. But year to date, we're down 5.8%. So we are still in this descending triangle pattern, if you want to label it such. It's as simple as lower lows, lower highs, bearish structure in the short term. Longer term, you're still in this large term weekly uptrend, but in the short term, we have been testing down 6% at the lows, closed down 5.8%. Can look at the weekly chart very quickly now and just show you that we're testing the higher lows that this structure had formed previously. We're starting to test those points. If the price action starts to hold, closes beneath that, this could be taking the stairs up to then have the elevator down. There's unfilled gaps here. The gaps don't have to be filled. If they are filled in a scenario where the gaps are filled, we went over it the last recording, but still, to fill the gap, the market would decline 17%. On top of the currently down 5%, you are in bear market territory. You're starting to retrace all of 2025's range. So this was talked about in the other recording. I didn't want to get too into the weeds with this. No real update on the S&P 500 index. The S&P 500 index is essentially moving in tandem with the NASDAQ. They are highly correlated, and when one is having a very bearish day, the other is most often going to have a bearish or very bearish day. The NASDAQ is something that I'm focusing more on than the S&P based on the seasonality analysis. The seasonality showed average range percent of the NASDAQ and IWM greater average range percent, taking the high minus the low divided by the open for every trading day. You can compare the statistics, and the SPY on average has less range than IWM and the NASDAQ, so why look to trade the S&P 500 if it has less range? Go where there's the most range, you can capture the most potential gains. So I don't really see much changing on the NASDAQ, or I should say on the S&P 500 and the NASDAQ daily structure. The charts are highly similar. They're nearly identical charts because they have similar components. Parts of Amazon, parts of Apple, parts of Google, you name it. There's mega corporations that compose the S&P 500 and the NASDAQ. And the only other thing I really wanted to update was Bitcoin because, again, we're starting to hold the higher low structure. I'm trying to hold my tongue and not have a shift to being bullish in the short term because the last time I did that, we started to roll downside. And it's not my opinion changes the market sentiment, but when your opinion starts to shift, that's when the market can kind of flip and it's at an inflection point. At the inflection point, right when you start to capitulate in one direction, then flips in the other. So I just see that Bitcoin is holding higher low structure. We're shifting to the bullish green here, so we could see some expansion. I'm neutral. I'm no longer bearish Bitcoin in the short term unless you're beneath. If we're beneath 64,000 on Bitcoin, it will go lower. I don't understand how we would be back testing 64, 63, 62,000 and not be making new year-to-date lows in Bitcoin. If we are holding the higher low structure here, higher lows lead to higher highs, so more likely to break higher. But this is an oversimplification, and I guess the other thing is the trade-weighted dollar. Ever since the escalating tensions in the Middle East between Israel and Iran, the trade-weighted dollar has started to rally. The dollar is gaining strength. The Federal Reserve has held interest rates flat, steady for the last 2 meetings. So long-term rate estimates rise a little bit. Gold declines because gold doesn't pay a yield, and also gold is going to be extremely volatile moving forward simply because of the derivatives attached to it, how it's no longer a safe haven investment, hedge against inflation. Now commodities, gold and silver, with the derivatives markets, they've become much more speculative assets, a blend of speculative assets and hedges against inflation. So when I look at gold and the declines that have occurred, I understand that it's a natural mechanism of over-exuberance, massive move to the upside. You're going to have profit taking, but the further profit taking that we've seen after the second move that made a lower year-to-date low on gold, I believe that is likely due to the dollar gaining strength, and that's correlated with a rush to safer assets, debt-denominated treasuries that give a risk-free interest rate, and the changes in the Fed's position, long-term interest rate cuts are less and less likely. So those factors influence the trade-weighted dollar. Trade-weighted dollar influences global currency flows, and it also influences how money's flowing into the US markets. When the trade-weighted dollar is rallying, that's typically not good for the stock market. Year-to-date, trade-weighted dollar, you can see basically from its late January low all the way up to the high that it made in mid-March here. Very quickly, back to the NASDAQ. The NASDAQ high in late January, making its low now. You can see the graphs are inverted. This inversion is because the NASDAQ, the S&P, these baskets of stocks are denominated in dollars. So when the dollar loses value, it takes more dollars to buy the same basket of goods. The dollar has less purchasing power, so it takes more dollars to buy the same basket of goods. When there's less and less purchasing power, it's lost its value, it takes more dollars to buy the same basket of groceries or the same basket of stocks. So when the dollar trade-weighted Dixie here, when it rallies, not a immediate guarantee that stocks will fall. It's not a one-to-one correlation. No. I should say it's not a one-to-one causation. There is a correlation to a degree where when we see the trade-weighted dollar rise, it's correlated with declining equity prices. So I don't think there's anyone live in chat that has questions, that wants to ask anything. If there was, you could ask them. I don't know if anyone is in chat that wants to ask a question like, hey, show me this ticker, or hey, I'm a bot. That'd be interesting if someone said I'm a bot. But I didn't want to make this the longest wrap up QQQ after the bell recap of the QQQ before the market episode 1. Sorry, QQQ before the bell episode 1 has already been done. This is just the second after the bell recap of the report here. Not much to really go through besides prepare you for next week. I have the rough draft ready for QQQ before the bell episode 3, covering the preparations for Wednesday, March 25th, 2026. I'll have this out later. I think I'll just keep it where Substack is posting, I think 7:30 is the time frame the emails get sent out. So that's when it goes live. And until the next recording, stay green, traders.